There is a big question that many here on Wall Street have been asking as of late. Are meme stocks really back? And if they are, what does it tell us about current market conditions and overall sentiment for retail investors? Between surging interest in names like Kohl's and Opendoor, even American Eagle as of late getting in on some of the fun. To help us unpack all of it is Spencer Jakab. He's investing columnist at the Wall Street Journal, also author of the newsletter Markets AM. Spencer, thanks for being here.
Hey, sure.
Okay, so resurgence in meme stocks, are they back? Is it not quite what we saw in 2021? What do you make of it, of what we've seen as of late, specifically a few of these higher profile names the last couple months, like Opendoor and Kohl's last few weeks?
Yeah, these have been named the dork stocks, not because they're a bunch of dorks buying them, although that's possible, but because those are the ticker symbols or the first letters of the ticker symbols of the four stocks in the thick of this. It's a weaker version for sure of what we saw in January 2021 with GameStop, AMC, and the rest, because the market's not taken by surprise as much. You had Bed Bath and Beyond in between and other meme stocks, and so it's not as extreme, but it's definitely the same trend and the same techniques being used to push them higher.
Dork stocks. Okay, I got Opendoor, I got Kohl's. What am I missing? What are the other two?
You got Krispy Kreme, which is the D, donut, and then Kohl's is the K, Opendoor, and then Rocket Companies, the mortgage company, New York.
Tell me about the ways that we're seeing this recent iteration. I mean, obviously, if you were rotating into meme stocks, in general, I'd have to imagine retail investors are adopting a risk-on attitude. In what ways this is similar from the 2021 Wall Street bet surge, and in what key ways do you see some differences?
So, I mean, the ethos is the same, right? You have basically, I would divide the people who buy and try to push meme stocks higher into two different groups. There's the smaller group that really want to create some mayhem with their brokerage accounts. And you can do that these days because you have these weapons of mass destruction, asymmetric warfare that you can wage using things like out of the money call options, where a lot of people with small amounts of money can make these stocks go up, and when they're heavily shorted, which these were, then people have to cover, and it becomes, for a brief time, a self-fulfilling thing. Then you have another group that just wants to make money. That's the larger group. They think, they're the people who walk into a casino and think that, yes, it's true that most people don't make money playing blackjack, but they're smarter and they're a bunch of chumps at the table and they'll do well. And it usually does not work out. But of course, if you're very early in a meme stock squeeze, then you'll do okay.
What signals do you think we could take away from the overall trading activity we're seeing today? Does this tell us anything about the broader market, that we do have so many people that are willing to kind of play what is at times very much a speculative game?
It absolutely tells you something about the broad market, and it's not a good thing. If you speak to confidence experts, if you look at past episodes, and not just meme stocks, that's too short of a phenomenon. But if you look at a spike in the values and trading in unprofitable companies, speculative companies, that tends to proceed, but not immediately proceed to come up. And think about January 2021. You had this tremendous run from the COVID lows. It did keep on going for a while, but that really marked a kind of a klaxon alarm danger signal that this was getting too crazy. And Goldman Sachs recently came out with a report where they recreated this indicator, the speculative sentiment indicator, and they've showed that in the next 3, 6, and 12 months, usually markets do keep on going, but then after that, the wheels start to fall off. Of course, they could start to fall off before that, but meme stock speculation is definitely a sign that there are individual traders throwing caution to the wind. And if you're just a normal investor who doesn't own these stocks, that's something to think about.
And I'd imagine these are largely retail investors. And I ask because we've had there's an interesting narrative on Wall Street right now that says if you go back to the depths of the April 7th, April 8th recent lows in the stock market after so-called Liberation Day, where the S&P 500 sold off 20% to those, at least those intraday lows. We briefly hit bear market territory. That it was retail investors who bought those dips aggressively and have been able to ride out the 30% or so gains since then, with institutional names, ironically, somewhat on the sidelines. Does that maybe help explain why so many retail investors have been maybe more willing to have that riskier appetite, because maybe they've sort of, ironically, maybe kind of outperformed the institutional names given the wild volatility in the market since April?
Yeah, it is absolutely the case that retail investors have driven this rally. They have done very well, and it's an echo of what we saw in March 2020 when Warren Buffett, greatest investor of all time, was selling airline stocks, and you had retail investors coming in and buying airline stocks, the last thing that you would want to buy. And they, when individuals come in and outsmart the pros, at least briefly, and feel like geniuses, they're emboldened. And what the two have in common, the two episodes, is that you had this scary episode for people like me, who watch the economy and try to read the tea leaves in the longer run, and buy. Well, I don't buy stocks, but I mean, people who advise you whether or not to buy stocks based on the fundamentals. And you had a very, very short, sharp sell-off. So the reward for being contrarian was extreme, and it was individuals who throw caution to the wind who made the most money, the people who were very active. And if you just slice the market up into unprofitable versus profitable companies, or high beta, the more volatile companies versus less volatile companies, unprofitable, I mean, any way you slice it, it's not just meme stocks. The speculative stuff has done very, very well, and that's exactly the kind of thing that retail investors are buying. And so, ironically, grudgingly, you have the pros following the retail crowd, because the last thing you want as a money manager is to be left behind, and a lot have been left behind because they were scared out of their wits back around Liberation Day.
What a world that we've had with these markets. That was my suspicion, and I appreciate you largely confirming that. Talk to me about the actual benefits these companies now get to receive. It's not simply having their share price gain. I think back to actual legitimate benefits to AMC and GameStop, and I wonder, do you look at the dork stocks to say, hey, valuations out the window, regardless of the underlying fundamentals, these companies now become inherently strengthened to some degree because they find themselves in the crosshairs of the meme frenzy?
Yeah, absolutely. That's a good question, because there are companies, and the reason that there was a lot of short interest in these companies was that some professionals, long short hedge funds, for example, they might have said back in 2020, 2021, okay, I like Best Buy, or I like Dillard's, but I'm also going to bet against some retailer, and there's no better retailer to bet against than GameStop. It's this mall-based seller of video games. Everyone knows those are going digital. This company is slowly going out of business. AMC, well, the pandemic, they already were doing badly. The pandemic had them a few months away from bankruptcy, so I'm going to bet against them. And so a very weak company that is headed for bankruptcy, and in the case of those two, they took full advantage. It's not just that your share price goes up. You get no advantage when your share price briefly goes up. But if you can issue stock, if you can issue convertible debt, if you can take convertible debt that you already have on your books, like AMC did, and have it converted, basically take the debt off your books because the person who owned that can't believe their luck, and converts it into stock, and then immediately sells it, then that bolsters your balance sheet. And both of those companies are still in business, really as a result of the meme stock squeeze. We haven't seen that this time. We did see it with Bed Bath & Beyond, although it didn't happen. It wasn't enough and didn't happen for long enough. But there have been other companies that have basically taken advantage of, like, okay, you guys want to buy our stock at 10 times what it's worth? Here's some more. We're going to sell some more. And they'll do that all day. And it's questionable whether or not that's ethical. If you're a CEO, if you have a bunch of people who want to buy your stock, who are crazy about it, who have very strange reasons for buying it. Well, it takes two to make a market. One could say that that's a CEO's responsibility. This crazy thing happened that saved us, and we're going to sell a bunch of stock and stay in business. And it's the best thing for our employees, and it's definitely the best thing for them. I mean, the CEOs of these companies did very well for themselves too. So, yeah, we haven't seen it yet with the dork stocks, but we might. It hasn't lasted long enough, really, for it to happen.
Yeah, that was my suspicion. Fascinating. It is fascinating to have this conversation once again all over Wall Street. Very grateful for your time and much needed perspective. Spencer Jakab, investing columnist at the Wall Street Journal. Spencer, thank you.
Thank you.